The biggest mistakes beginner investors make aren't the ones you always hear about. They're the ones that no one wants to admit because they are embarrassing. Everybody talks about waiting too long, trying to time the market, or not diversifying. I've been investing for 15 years, and I'm going to share the real, unfiltered mistakes I made when I first started, so you can learn from them without making them yourself. Mistake number one was letting the whole process intimidate me. When I first logged into Vanguard, I was so scared I thought I could lose money just by being on the site. The terminology seemed too complicated. The whole experience felt very uncomfortable. Looking back, I wish I had a better perspective. Doing something for the first time is always scary and uncomfortable, and when there's a chance to lose your hard-earned money, panic is very easy to fall into. So for my first investment, it took me a couple of weeks just to click around, compare different funds, and get comfortable enough. Then when I finally bought my first fund with the $3,000 minimum, I thought that the sky was going to fall as soon as I clicked the button, but it didn't, and over time, it got a lot easier. Even though I've been investing for over a decade, I still feel a little scared every time I make a transaction, and that's okay. The key is once you set it up, you don't need to make many transactions. The less you mess with it, the more it works for you. Mistake number two was selling Apple stock in 2019 during a 5% market dip out of fear of losing money. If I'd held on, I'd make over 5 times my initial investment today. Looking back, that dip was so small that I can't even find it on the graph. It's a perfect reminder that markets always recover. Watching those shares bounce back and continue growing taught me a pretty valuable lesson. Market dips are temporary. Short-term drops don't mean the end of the world. They're just part of the cycle. Fear can drive you to make bad decisions. It's easy to panic when things drop, but pulling out early means that you miss out on future growth. When you focus on quality stocks and invest in solid companies with long-term potential, you don't have to worry about checking up on those investments too much. If you're a brand new investor, picking individual stocks can feel very exciting, but also scary because if you pick the wrong one, you can potentially lose a lot of money. And this brings me to my mistake number 3, investing in something that you don't understand. It's human nature to look for shortcuts. Everybody wants to find that one investment that will make them rich overnight, but more often than not, chasing quick wins leads to costly mistakes. Early on, I thought that it was a good idea to buy a handful of penny R&D stocks, research and development. These were small companies with big promises about the next breakthrough technology or a medical miracle. Penny R&D stocks are often highly speculative. If their R&D leads to a successful product or breakthrough, the stock price could skyrocket overnight. But most of the time, they struggle with financing, fail to bring their ideas to market, or just fizzle out. These stocks don't have the financial stability of bigger companies. A lot of them don't have significant revenue and rely on venture capital or future fundraising just to stay afloat, which adds even more risk. Investing in these stocks for me required reading through tons of earnings reports, tracking FDA approval, and staying on top of development milestones. I did make a decent profit on one of them, but the rest never really panned out. And honestly, I didn't enjoy the process. It was a lot of work, constantly managing and tracking every little update. In the end, this was not where I wanted to spend my energy, so this wasn't the strategy for me. Mistake number 4 was making my Vanguard portfolio way too complicated. In my effort to build the perfect portfolio, I kept adding more and more funds, thinking that I was diversifying. But what I didn't realize is that a lot of these funds held the same stocks, creating a ton of overlap. I was basically just holding multiple versions of the same thing. Eventually, I simplified everything down to a few solid, diversified index funds, and not only did that make my life easier, but my portfolio performed just as well without all the unnecessary complexity. And my mistake number 5 was forgetting to actually buy a fund. I know it sounds ridiculous, but it happens more often than you'd think. When I opened my Roth IRA with Vanguard, I set up automated transfers into my Vanguard settlement account and walked away without purchasing a fund. The funds were just sitting there. A few months later, I logged in and realized that I had never actually bought the fund. Looking back, it was such an easy mistake to make, especially as a beginner. So now I always double check that my cash is actually invested and not just sitting on the sidelines. Based on these mistakes, I put together a guide for you. The download link is in the description of this video. Thank you all so much for watching. I'll see you in the next video.